Hello, everybody. My name's Tree Demon, and I'm the Devil's Stockbroker. I was reading through the news, and I recently did some digging on a few events that have happened to a lot of the different banks and mortgage lenders recently, and a lot of this is playing into one of the signals of a major housing crash that I thought was very important to go over. So this video, I'm just going to take you through all of the different mortgage lenders and banks that are currently having struggles with keeping their employees. A lot of them are doing mass layoffs right now, letting thousands of workers go, and it's causing a bit of a stir on Wall Street and elsewhere in the world. So let's just get straight into it. JP Morgan lays off hundreds of employees in mortgage division as rates spike. This was just one of the recent ones, but earlier this year we've had Wells Fargo that had earlier laid off several hundred workers. They've just laid off several hundred more as of yesterday. This was published by Des Moines Register just on the 5th of July. Currently, JP Morgan and Wells Fargo are the biggest ones. There are other lesser known non bank lenders, however, that are more concerning because uh, as you may recall from one of my earlier videos last week, I discussed how non-bank lenders represent more than 60% of the total mortgage lending capital that is out in the U.S. housing market. What this means is that almost two-thirds of the entire housing market is lent from non-banks. These are individual capital firms and companies which lend out to homeowners that are or those interested in purchasing a home, and a lot of these companies are struggling to keep up. One of the most famous signals of the subprime crash back in 2007 was LendingTree laying off more than 400 workers. LendingTree themselves was actually, at the time, one of the largest, but not quite the largest, non-bank lender in America. And during the subprime crash, tons and tons of their lending practice was just let go out of the blue in May, just ahead of the subprime crash, and there was no real explanation for it. This actually published on May the 12th in 2007, a full 2 months before the subprime crash hit its peak. This mass layoff that occurred in LendingTree signaled one of the largest panics on Wall Street that took place in a single week. This was actually when the overall stock market was at its highest point at the time. Currently, we're in a slightly different situation right now where the SPY has been going down for some time. We have been in a bear market for at least several weeks, if not the last several months. And LendingTree now is actually the largest lender in America, making up a bulk of that 61% of mortgage lending from non banks in the United States today. LendingTree's stock is actually currently tanking down to 46 and 97 cents, down from almost 400 where it was trading at in the beginning of the year. From its peak during the SPY's high in July of 2019, LendingTree has only continued to trickle downwards over time, but the big one that I'm pointing out here is when it completely cratered on news that they were struggling in February of last year. Seeing the largest non-bank lender in America struggling so much with its stock is a huge sign of things to come. And overall, in news provided on the internet, not by mainstream media, there are constant articles being published of just massive cutbacks to mortgage lending and mortgage origination. According to this article, there was over 86,000 mortgage job cuts in 2007 by itself, and far more as the banks began to fail when Bear Stearns, Countrywide Financial, IndyMac, and Washington Mutual all eventually collapsed. Most of these banks were acquired by other banks that we know today, such as Bear Stearns being acquired by JP Morgan Chase, Washington Mutual being acquired by Liberty Mutual, and others of those other names similarly. One of the things that I want to highlight in this article is at the time, 2.33% of all U.S. mortgages were delinquent. This is currently only slightly higher than where we are right now with current delinquencies at 1.75%. The thing that I want to make sure everybody understands is there should be no delinquency. We're actually at record low delinquency today because of forbearances on mortgages and other loans, which the government has not forgiven but forbeared and deferred debt to the banks in order to allow people during the COVID pandemic to catch up on their payments. The fact that we have high delinquency at all, the fact that we have anyone who is in serious delinquency that's more than 90 days late on their payments is a huge concern. I'd like to bring your attention to Black Knight, which reports on mortgage, foreclosure, and housing inventory data every single month. According to Black Knight, we recently hit an all-time low, down to 2.8% in April, down 4 basis points from March, hitting a new record low for the second consecutive month. And overall delinquencies are down 40% from last year as the mortgage market continues to recover from pandemic-related impacts. However, what I wish to point out here is that the foreclosure pre-sale inventory, which is homes that are now foreclosed upon and are being added to the foreclosure inventory, has been rising month over month and year over year. The fact that anyone is going into foreclosure now, as we come out of the pandemic, after people have been given forbearance and forgiveness with a chance to get out of their homes, either to sell them during record equity growth or to catch up on their payments if they had no other options, is a huge, huge signal that things are not as fine as what the Fed would indicate to us. And even the Fed recently has been changing its tune along with other mortgage lenders and real estate data analytics providers such as Redfin, saying that the market is going to turn around and take a turn for the worse. Currently, we see that there is a year-over-year change of 228.5% increase in foreclosure sales. Now, because the data is tainted by the previous year where no foreclosures were permitted, does affect this pretty strongly. However, month over month, when we just re-entered a period when foreclosure was permitted to begin again, the fact that we are in a rising trend of foreclosure sales and additions to foreclosure pre-sale inventory is a sign that people are struggling to make their payments. Everybody that was in that situation of fearing and facing foreclosure before the pandemic began is right back where they started, and that hasn't changed for anybody. This site also provides a list of the most at-risk states for the ones that are the likeliest to go into foreclosure early. I've been staring at this data for quite some time, and I recognized a few trends that the big states which are most desirable, i.e., California, Colorado, Idaho, Washington State, are some of the last in the list because foreclosure processing takes the longest for these states in particular. The ones that are most at risk, Mississippi, Louisiana, Alabama, Oklahoma, West Virginia, all these states have the thing in common that it takes less than 90 days for foreclosure to be completely processed on average within those states. However, I've been tracking this data a lot closer, and there are some states which are at risk, which are very desirable, such as Texas, which has already begun massive foreclosure processing, and cities such as Austin, Texas, Houston, Dallas, Fort Worth area, all of them are currently at risk of foreclosure for anyone who is not able to make payments within 90 days. According to Adam, the average days to complete foreclosure have only gone up since 2008 when the crash occurred from the subprime lending crisis. At the moment, overall throughout the United States, we're at an average of 917 days. But what I want to point out is that most of this is caused by states which have long delays in foreclosure processing, such as Hawaii, which takes more than 2,500 days on average to close a foreclosure. Louisiana at 1,970, Kentucky 1,890, and so on. There are many, many other states which are far faster, such as Texas, with less than half a year to completing foreclosure processing. As these homes go into foreclosure and enter the market, it's going to add more inventory to the supply of housing and further put pressure on the housing market. This is going to cause sellers to get more urgent about getting out of their homes and collecting what they can from it. So between massive foreclosure starts, the data all pointing to housing supply rapidly increasing in the next 6 months. What does this mean for all of the other banks, and what can retail do in order to prepare for it? The first thing that I want to point out is that the banks are not okay. Most of the banks are actually in quite a lot of trouble, and they're doing layoffs. Even the big banks like JP Morgan Chase and Wells Fargo, two of the top five banks in the United States, are at critical risk. And because of that, their stock is going to be a likely target for shorting. JP Morgan, which is one of the most valued banks in the United States, is already down from its highs by more than $60 per share. The overall performance since 2020, when the COVID crash hit us, they're now only about 45% up from that point. JP Morgan, I think, can fall further, but there are other banks such as Bank of America, which I'm currently targeting at the moment, that still is pretty far above its post pandemic crash levels. At the moment, I'm targeting Bank of America to drop at least another 30% in the near term between now and 2024. For those that are currently invested in the market that are looking for opportunities in order to collect something and protect themselves, hedge against a crash. This is part of what I'm doing as a part of my overall strategy. But one of the things that I do want people to be careful of, especially if you were considering buying a house or if you still are, please reconsider the cost of mortgaging a home right now with the interest rates rising. It's phenomenally high compared to where we were. A 5.5% interest rate on mortgages is going to be really expensive, and you're probably going to be in a position where even if you're a qualified mortgager, you're going to most likely have to put down 20% just to qualify for an FHA loan. Lenders are completely tightening up. There's not much cash to go around. And the thing is that right now the equity in the market is at all-time highs. It doesn't make sense to buy right now. I've been analyzing the U.S. median sales price for houses in the United States, and our bubble has just absolutely exploded in terms of housing equity in just the last 2 years. I mean, this is what this is a 30% increase in equity in the U.S. housing market median sales price. That's an absurd level of growth in such a short amount of time, and these prices won't stay here. So don't be concerned about the high interest rates, and don't be concerned about the high housing prices. It's very likely that the housing prices are not going to stay there. But the real takeaway here is the banks are in trouble, and there's a lot of other signs going on in the market that tell us this. One of the things that I want to point out is that a lot of the big banks are increasing their dividends. Some of them are actually doubling their dividend. Morgan Stanley themselves, back in June of last year, doubled its dividend, and along with JP Morgan Chase, in order to entice investors to get in. But as you can tell from the stock charts, JP Morgan Chase has not performed well. JP Morgan Chase themselves have retraced by more than 33% since they increased their stock dividend. Interestingly enough, companies, banks in particular, such as Wells Fargo, JP Morgan Chase, Bank of America, all increased their stock dividends just months before the 2008 crash took place. And if you went all the way back in time to 2008, right as the crash was about to hit, you'll go back and find that almost all of the big banks had increased their dividends exactly within between April and July of 2008, as the market was starting to really turn against everybody. And you'll find if you go back in time, virtually every single crash was precipitated by banks increasing their dividends by significant margins in order to entice investors to get into their stock. And what ended up truly playing out was all of those big banks, large institutional investors, were selling to retail investors and pension funds in order to get their bags out of their hands, cash in, and move to cash before the crash occurred. And they knew it was going to come. The big takeaway here that I want everybody to be aware of is that, one, mortgage lenders, especially non-bank lenders, are in massive trouble, and people should be extremely wary of taking on any mortgage or any new loan at this time. Second, there's going to be a huge push for the repo market, and anybody that is delinquent on loans, especially car loans, from anecdotes that I'm hearing from other investors, is that anyone who is even late on a single payment is at risk for having their car repoed, especially on title loans. And if you go to like one of those loan sharks that put your car up for collateral, they will take it right away, because right now the used car market is exploding right now. Be extremely cautious if you are ever in that position where you need to take a loan. Please, please do whatever you can to avoid that situation, avoid missing those payments, because they are ruthless, man. Third thing to take away from this is that all of the banks are currently in trouble, and they are going by their playbook to increase their dividends, increase shareholder value, air quotes, in order to entice investors to jump in right now while the stock has still got some value in it, so that their big institutional investors can get out in time to buy the dip once the crash finally hits its bottom. We are nowhere near the bottom right now. And then finally, foreclosures and major housing surges in supply are coming very soon. So if you're in a position where you're considering buying a house, or you're considering doing any kind of investment, please just wait it out. Wait it out. Don't listen to the real estate investors. Don't listen to the real estate brokers. All of them are currently in panic mode, trying to empty their bags. You need to be careful of who you're listening to. Trust your gut. Listen to your closest friends and advisors, and really, really consider the nature of the market that we're currently in and the current mood for the United States overall. Everybody that's on the streets is currently trying to pinch their pennies. Trust me when I say that everybody is in the same boat right now. All the institutions and the banks are trying to save every dollar they can and hedge against a coming crash. They know it's coming. You should be ready too. That's going to be it for this video today. Thank you guys so much for watching. I'll look forward to seeing you in the next one. Until then, have a hell of a time in the stock market.